Katrina Haynes from Haynes and Associates. You're about to watch a brief snippet from one of my webinars. I'll be back when it's over to give you more information. Enjoy. We're going to jump right into it and start talking about what is a tax equalization. So the most important thing to understand about tax equalization, especially if you're getting into it for the first time or you're coming across it for the first time, is that tax equalization is an agreement between an employer and an employee, whereby the employer will absorb the difference in income tax costs should the employee's liability increase as a result of an employer-sponsored assignment. So when you're sending someone on an employer-sponsored assignment, and this is anywhere in the world, it doesn't have to be with the US, but because most of us are in the US or work with clients that are in the US, we will talk about the US a great deal. But I do want to be clear that a tax equalization policy does not just cover individuals into or out of the US. It typically is a global policy because you're dealing with a multinational corporation. So the agreement then is that the company will absorb excessive tax costs. As a US citizen or green card holder, it's probably more important for us just because US citizens and green card holders are responsible and subject to income tax on their worldwide income, even if they're not living and working in the US when they earn it. So that means you could go overseas, you could move to France, and you could be living and working in France for 20 years, as long as you remain as long as you still have your green card and it hasn't been administratively surrendered, and as long as you're a US citizen, you are still subject to income tax on your worldwide income. Now, there are things that you can do to offset that duplicate tax, such as the foreign earned income exclusion, the foreign tax credit treaties, and things like that. But for the most part, the US is required or is able and entitled to, not just able, but is entitled to tax your global earnings no matter where they are. So if you are going to France for your employer for 5 years, guess what? Because you're a tax resident of France, France is going to tax you, and most likely they're going to tax you on your worldwide income as well. So if I send someone out into the world and say, you know what, I know you're a US citizen, you're going to France, you're going to have to go to pay tax at whatever the French tax rates are. I'm pretty sure they're higher than the US tax rates are, because despite what people think, the US as a global tax system, our tax rates are pretty low. But you're going to have to pay tax in France. You're also going to have to pay tax alone. Thanks for watching. For more information on this and other webinars, you can check the description box, or you can visit me on my website, www.hayneshelp.com. Thanks again for watching and for letting Haynes help you.